Okay. Now what they are saying is this is related to which chapter? This is related to IAS 14. Okay, it is IAS 14. Is it? Now, Scrooge owns a herd of cattle. Cattle means agriculture. Okay, cattle means agriculture, which produces milk. Scrooge turns these into a cheese, commercial. Is it right? On April 1st, 2005, Scrooge purchased a fleet of sheep, 100,000, which include a transaction cost of how much? 5,000. Means, is it right? On see, this is slowly and steady. We'll put like this. Today's date is what? Today is 11/11. Okay, 11/11. And fine. Is it right? On 1/4/2005. Is it right? How much they have purchased? They have purchased for this much. Is it right? This is the purchase price. This is the purchase price. Fine. Now they have added 5,000. Is it right? This is transaction price. Is it right? This is transaction price. Now this is happened here. Okay, fine. Put one dash there. Now what happens? Include at March 31st, 2006. Is it right? March 31st to after 1 year. Okay. What is the value? Value is how much? 120,000. Every animal are sold at a 5% commission fee. Is it right? They are sold at what? They are sold at 5% fee. Okay, commission payable to the agency. Shruti uses historical cost model and charges all depreciation as an operating expense. Fine, that is normal thing. In addition to this, Shruti uses a number of items of specialized farm machinery. Is that the machinery cost? How much they have? They are using machinery. Is it right? How much machinery is there? Machinery is 1/1/4/2002. Is it right? They have purchased how much? 200,000. Life is how much? Life is 10 years. Is it right? Now, as 31st March 2006, there is only one supplier who still sells the machinery, and the current price of machinery is how much? Is it to current price of machinery? How much? Current price of machinery is 300,000. Is it? Current price of machinery is how much? 300,000. Is it? Now, fine, good. Which of the following items held by Shruti should be accounted under the provision of IAS 41? Is it right? IAS 41. Just I will go to that chapter. Is it right? I will go to the chapter of IAS 41. Is it IAS 41? In IAS 41, what is there? This is IAS 8. Is it right? IAS 8. This is IAS 8. Is it right? This is also IAS 8. Is it? We will have IAS 30, IFRS 13. Is it right? This is IAS 2. Agriculture items. Is that IAS 41? IAS 41. They put like this. Fine. Okay. 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 IAS 41, agriculture relates to what? Agriculture relates to what? Biological assets and plants. Is it right? A biological should be treated as an economic benefit. Is it right? What is the? It should have the economic benefit with flow. Is it right? Then it is a biological asset. The cost of the fair value asset should be reliably measured. Is it right? The entity should control. Is it? Now, what are the agriculture produce gains or losses in profit or loss? Is it right? gains or losses on recognitions are included should be lost, profit and loss. After once you have produced and harvested, it is going to cease. Means it is not going to be there. Trees, is it right? Trees, animals. Okay, after age, animals will die. Okay, trees, after some time, trees will get the non-productive. Agriculture produce becomes an item of inventory. Product which are result of processing, is it right, will be dealt in IS2 or other applicable standards. Is it? Is it means what happens? We have to understand that whenever there is a when we have to treat whenever there is a profit or loss, that has to be done on operations. Is it right? When it has been done, then it is going to be treated as a agriculture produce. Now, is it right? Now you have to make sure that what is herd? Is it right? Herd of cattle. Which type of asset it is? It is a category of what? Biological asset. Is it right? It is a category of what? Biological asset. Is it right? Next. Is it milk is going to be called? Milk is going to be called as a milk is going to be identified as a, is it as a agriculture produce. Is it milk is categorized as a agriculture produce? Is it cheese is classified as a inventory? Is that because it is coming from where? It is coming from processing. Is it right? It is coming from agriculture produce. Is it means milk we are not processing. Okay, milk we are not processing. We just we get the raw milk, as simple as that. Is it right? What we are getting in the bottles, that is a different thing. But technically speaking, milk is not produced. Is it right? Which of the following is going to be treated as a biological asset as per the rules? Is it right? As per IS 41, is it right? We have to take it as a biological asset. What one? Herd, is it right? Herd and cattle is a biological asset. Anything which you are talking in terms of processing, is it right? Anything in terms of processing, is it? It is going to be in the inventory, is it right? It is going to be inventory. You have the milk, is it? Agriculture produce, is it right? You have the milk. It is also going to be identified as a IAS 41. This is identified as a IAS 2. Is it right? This is identified as an IAS 2. Inventory is IAS 2. Okay. Whereas herd and milk will be carried as a biological assets and agriculture asset. Answer is what? Answer is C. Fine. Are you clear? Next. What gain should be taken in the suit profit and loss account for the year ended 31st March 2006? Is it right? Now, initially the value of sheep is how much? See what we have written there. Initially, see it is this is okay. Fine. This is over. You put like this. Is it right? You put like this. 287. Okay. Question number 287. How much is it? How much is the purchase price? Purchase price is 100,000. Transaction price is how much? Transaction price is 5,000. Is it right? Fair value is purchase price. Is it right? Purchase price is how much? 100,000. Less. Transaction, what that fee, is it what they have done? Transaction cost. Is it transaction cost? Transaction cost is how much? 5,000. This is the fair value. Okay. Now, what they have said that what they are asking, what is the year end? Is that how much you have to? What is the gain we are going to get in the year end? Is it right? This is the value as on when. This is the value as on 1/4/2005. Is it right? Opening. Okay. This is the opening. Closing is how much? Closing is how much? Value is how much? Value is 120,000. Fine. Value is how much? 120,000. Then they are giving how much? They are being fee. Is it right? Commission they are giving. They are giving commission of how much? 5%. How much is the 5%? 120 into 0.05. It comes to how much? It comes to 6,000. Is it right? It comes to how much? 6,000. It comes to how much? 114,000. Is it? It comes to how much? Now, okay. What is the gain? What is the gain? Gain is this is the opening balance. Is it right? This is the opening balance. This is the opening balance. Is it right? This is the opening balance, and this is the closing balance. Gain is nothing but closing balance. Is it right? Closing balance is how much? Closing balance is 114 minus opening balance is how much? Opening balance is 95,000. Difference is how much? 19,000. Next. Okay. Next. What they say, under current cost machine, what is the value of machinery? Okay, under the current cost, what is the value of machinery? Now how much when we have purchased machinery? See, when we have purchased machinery on 1st of 2002, is it right? As 31st March 2006. Is it right? How much is there? How many years has been over? 2002, 3, 4, 5, 6. 4 years. Okay? 4 years. Okay? 4 years elapsed. Is it right? 4 years has been elapsed. Okay? I will write clearly. 1 minute. 4 years. 4 years has been used. Fine. Now, what is this? Simple. Where is it? What is there? They ask, what is the current cost? Is it right? If current cost is there, is nothing but What is the current cost? Current cost of machinery is how much? Current cost of machinery is 300,000. Is it right? Minus depreciation for 4 years. Is it depreciation for 4 years? 1/4/2002 to 31/3/2006. Okay, 31. Now how much is there? 300,000 times 4 by 10. Okay, it comes to how much? It comes to 120,000. Is it right? It comes to 120,000. Balance is how much? 180,000. Is it? This is the value of machinery as on. This is the value as on 31/3/2006. Next. Good. Is it? Next. At 31st March, a valuation expert informed the directors of Scroot that the property owned and used by Scroot for farming has significantly increased in value. Okay, increased in value as such. Is it? Increased in value. This has been decided to look by looking at the price per square meter at similar products in the area and concluded that this should be used to value Scroot farm with no adjustments. Which of the following inputs within IFRS fair measurement value? Is it right? IFRS fair measurement value. I will just go through the other standards. I will go through the other standards. We will see what is the IFRS. Is right? It makes a little bit this is IS 8 IFRS. Is it right? In here, what is there? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants and is it right? See, actually now I will okay, fine, no problem. Nothing will happen, inshallah. I'm here. Is it right? Actually, what happens is that there are level 1. Just you keep the just you keep it as I will say that incomplete. Okay, I will say incomplete. I will explain you, and I will come back to this. Is it right? I will say. Is it? I have to tell you something on the conditions of IFRS, and I will do. Is it? I will do the next immediately. I will do. Don't worry about this. Okay. If Scroot choose to value the farm at the market value, which two of the following ratios will not be affected? Is that which two of the following ratios? See, what is the current ratio? Current ratio is thing but current assets minus current liabilities. Okay. You have any idea about ratios? Yes or no? First tell me. You have any idea about ratios?
No.
Fine. Okay? No, inshallah. Okay, fine, no problem. Is that current ratio talks about what? Current ratio. Is that I will write here, okay? We will do, maybe we will do this Saturday, we will do that, okay? Inshallah, coming Saturday. What is the current assets? Current assets is nothing but current ratio is nothing but current assets divided by current liabilities. This will never change, okay? This will never change. This will never change, okay? We will cover this. I will explain to you. No problem. Now, return on capital employed is nothing but profit before interest and taxes divided by capital employed. Is it? Gross profit margin is what? Gross profit divided by sales into 100, okay? Into 100. Gearing is nothing but gearing ratio is long term, is it right? Long term. We will not put long term. No, not like that. Non-current liabilities divided by shareholders. I have to write all shareholders equity plus non-current liabilities. Is it? Net profit before tax is nothing but net profit before tax divided by sales times 100. Fine. What they are asking us is that which of the two following ratios will not get affected. If not get affected, we have to see where the profit is not involved. Okay, where the profit is not involved, that ratios will not get affected. Is it right? Is it right? Now, market value. Is it at market value? Fine. If should choose to value the firm at the market value, which two of the ratios will not be affected? Is it right? See, now what happens if it is a market value? Is it right? Whenever there is a market value, is it right? Whenever there is a market, when market value increases or market value decreases. Is it? When market value increases and market value decreases, what will happen? You have to understand. Okay. When market value increases or decreases, what will happen? The shareholders equity will get affected. Is it right? Will get affected. Is that impact? Impact will be what? Impact will be on the shareholders equity. Fine. Impact will be on the shareholders equity. Impact will be on definitely. Impact will be on net profit. Okay. Net profit. Is that? Now. Is that? Impact will be on the net profit. Fine. This is we are talking about what? This is we are talking about the market value. Whenever the market value increases, definitely wealth will increase. Okay. Net, whenever there is a market value will decrease, net will decrease. What they are saying that how it is going to be affected, following ratios. Is right? Now see, this is what? Sales minus cost of goods sold. It will come how much? Gross profit. Gross profit minus expenses, all expenses, even it is on losses. We will get what? Net profit. Is it right? We will get net profit. Net profit, if you take on the other side of the balance sheet, if you take the other side on the balance sheet, you have the equity. Is it right? You have the equity. You have what is happening? You have the equity. Is it right? Now, whichever is not affecting, we have to take. Is it right? See, current assets and current liabilities are not affecting. Is it right? Current assets and there is nothing in current assets. Is it right? We are talking about the market value. Current assets and current liabilities is not affecting. The current ratio involves what? Current ratio involves current assets and current liabilities. This is not. This is the current ratio is not affecting. Is it? Return on capital employed. You have this capital employed. What is the capital employed? Capital employed is nothing but shareholders fund. Is it right? There are two approaches are there. Capital employed. One we can talk it about the equity approach. The second we can talk about the assets approach. Is it right? What happens? It will get affected whenever there is a change in the market value. Is it? This is not the answer. Gross profit margin. You see the things. You see here. What is the gross profit margin? Gross profit margin talks about cost of goods sold and sales only. They are not talking about anything on the profit. Is that this transaction is only for the level with respect to the inventory. Okay. We are not talking about the market value. So what happens? This will not get affected. Which one? Gross profit. Anything related to equity will get affected. Okay, anything related to net profit will get affected. Anything related to, is that? Now gearing is what? When you are talking about the gearing, definitely gearing is what? Net shareholders equity. Is that? Is a shareholder will get affected. Is that? Will get affected. Net profit, definitely we get affected. Means which two of the following ratios will not get affected? One is with respect to what? One is with respect to the current assets and current liabilities. The second is with respect to gross profit and sales. Is it? Gross profit and sales. Means we have to, what we have to have very clear. Conceptually, we have to be very clear about the ratios also. We'll do this, is it right? We'll do this. It's not difficult at all. Nothing is difficult. Only thing we have to do as much practice as possible. Is it right? That's the only thing. Is it clear about this? Just keep it in mind, okay? Now it is too early to say that it is the thing, but the ratios will have the same implications. Is it right? These formulas will also not change. Fine. Okay. Can I start the next one? Now, what it says, see, what is there? What is there? Is it? We are talking about what? We are talking about the leasing. Okay? We are talking about the leasing. Is it? We are talking about the leasing as such. Is it? Before see, this is the way we will work it out. Before you go for that, we will have a recap of leasing. Okay? What we have learned, a very running recap. Is it right? We'll waste that much time. Just we want to recollect the concepts. Is it right? Recollect the concept. When we are talking about the leasing, we have pay in advance, pay in arrears. Is it right? We have to that's pay in advance and pay as current liabilities and non-current liabilities. Is it right? Current liabilities and what is the finite period? Is that right to use? Is it right? We have done this. We have calculated the present values. Is it right? We have what is the lease term? Is that we have calculated what is the cash, how much you are discounting? Is it right? How much you are paying the lease? What is the discount rate? What is the present value? Is it right? Initial cost. And when we have that things, there is a general entries. Is it right? Liability will be credit and right to use of an asset is a debit. Is it right? If you pay in advance, how we have to calculate? If you pay in arrears, how we have to calculate? Is it right? This is a brief This is a brief aspect of what? This is the brief aspect of the leasing as such. Is it right? Now, payment in advance and payment in arrears. Okay. Now, right to use of the asset. This is little bit important. Okay, just revise this, because we yesterday also in a cash flow statement we have done this. Is it right? In yesterday cash flow statement also we have done this. Right of use of asset. Is it right? Is measured using the cost model. Is it right? Using the cost model, unless measurement is chosen. Is that initial cost minus accumulated depreciation? Fine. Is it? Sale and lease back. Fine. Now this is what is it? Just a recap about how we have done the calculations and subsequently how it has been worked out. Coming on 1st of October, Fino entered into an agreement. Is it right? On 1st of October, Fino entered into an agreement to lease 20 telephones to the team of sales. Is it right? Fine. The telephones are leased for a period of 12 months at a cost of 240 per telephone per annum. Payable in advance. Okay, payable in advance. The present value of the lease payments is this one. Is that this we have done? Is that present values we already they have calculated? We are not supposed to calculate anything. Is it right? On April 1st, Fino entered an agreement to lease an item of plant from the manufacturer. The lease required how many annual payments? 100,000 each, commencing on 1/4/2007. They have the useful life of 4 years and scrapped at the end of the project. The present value of the lease payments is how much? See, now what happens? See the thing. There are two aspects. On 1st of October, they entered a agreement to lease, okay, to lease 24 to its team of sales. They have taken lease, okay. The telephones are to be leased for 24 months. This much is the amount, present value. Now, Fino agreement to lease an item of plant from the manufacturer. Means here there are two different things. Is that this we are talking in terms of telephones and this we are talking about the plant. How much is there? 100,000. Is that the life of the is 4 years and the value of the lease payments is how much? 350,000. Cost of capital is how much? 10%. What they are saying, which of the following applies the principle of faithful representation to the above plant lease? What we have to do when we are talking in terms of plant lease, okay, how the things has to be worked out. Recording an annual rent expenses in Fino's statement of profit and loss. See, whenever we are talking in terms of lease, IAS 16 says that, is it right? IAS says that, is it? IAS 16 says that there should be a right to use. Is it? Right to use. It has to be identified as a asset. And whatever is outstanding, it has to be identified as a liability. In the liability, a component will be current liability and another component will be non-current liability. When you are taking the plant and machinery, is it right? When you are taking the plant and machinery, definitely right to use. Right to use is nothing but you will have control. For the control for for the lease period. Okay, control for the lease period as such. Is that now recording the annual? We are not, see, it is not a rent expenses, is it right? It is a lease payments. It is a lease payments. Fine. Expensing any interest on the straight line basis. No, we will never expense on a straight line. We are expensing on what? We are expensing on the balance method. Is it right? We are expensing on the balance method. We are never divide it. Is it right? We are expensing on the balance. Recording an asset in final statement of financial position to reflect what? To reflect control. See, when you are taking the asset on lease, is it right? When you are taking a asset on lease, is it right? It has to be shown on the asset side. Is it? It has to be shown on the side. Record 100,000 paid as a prepayment. There is no prepayment as accrued. The rule says that as accrued we have to show it. That is the reason what we are doing. We are talking in terms of current liabilities and non-current liabilities. The principle is as accrued, means this is also. It says that as recording an asset in final statement of financial position to reflect control, because we are taking the asset on a lease, we will have control over it. Is it right? We have the control over it. Is it right? The answer is what? The answer is C. Fine. Now, how much would be charged Fino's profit and loss account for the year ended 20 in respect of the telephones if it is applied to the exemption permitted under the 6 leases. Is it right? Now, how many telephones they are using? They are using how many telephones? They have entered into leasing agreement of 20 telephones. Is it right? Telephones are how much? Telephones are 20 numbers. Okay. Then and how much they are paying? They are taking it for how many months? They are taking. The telephones are to be leased for 24 months and the cost is 240 per annum. Is that 240 per annum? They are asking only for 2007. Is it right? Means how much each telephone is a 240 per annum. Is it right? What is the how much it has to be charged? Is it right? How much would be charged profit as loss account for the year ended in terms of telephone? Is that charge is nothing but expenses? Is it right? How much? 20 times 240, it comes to how much? 4,800.
Can you explain this again?
How many telephones we have taken? We have taken 24 telephones. Is it right? How many telephones we have taken? We have taken how many? We have taken 20 telephones. Is it right? We have taken 20 telephones. And what is the cost of each telephone we are paying? 240. Is it right? We are taking 24. Next. Now what happens? They are saying that it has been taken on 1st October. Is it right? It has been taken on 1st October 2006. They are asking us to calculate 2007. Is it right? 2007 means they are asking us to calculate for how many for 1 year. Is it 1 year? Now what happens? How much we have to show it in the profit and loss account as a exemption permitted under. See, what will go when if you apply for an exemption, definitely they will give you an deduction on that amount. How much we are paying, that much we are eligible. Is it right? How much we are paying, that much we are eligible. Is it right? How much we are paying here for 20 telephones? We are paying, is it right? 20 telephones. We are paying at how much? 240 each. Is it right? 240 each. Is it 20 telephones into, is it telephones into what is there? Into cost per telephone per annum per year. Okay, that is the reason we have done like this. 20 telephones into 240. Is it okay?
Yes.
Next. What would be the carrying amount of the right of the use of asset? Is it right? Plant. Is it right? What is the carrying amount of the plant asset? How much the plant we have taken? Plant we have taken for how much? 350,000. Is it right? How much is the plant? 1 minute. Is it right? Slow, one by one I will write here. Plant is how much? Plant is how much? 350,000. Fine. For how many years we have taken? We have taken for lease for how many years? Lease for 4 years. Is it right? Now what is the carrying amount? Is it right? What is the carrying amount? When we have taken plant for lease, make it sure. Is it right? On 2007 entered into an agreement plant and machinery for 4-year annual lease payments commencing 1/27. The plant would have useful life of 4 years and be scrapped at the end of this period. The present value of the total lease payments, is it right? The present value of the total lease payments is how much? Total lease payments of plant, is it right? 1. Right. Okay. Now, is it when they have entered the agreement on 1/4/2007? Okay, when they have entered the agreement on 1/4/2007. Is it right? I will write here. Okay, I will write here completely. Is it? See, when they have entered into an agreement 1/4/2007. Is it right? When we are preparing 39/2007, how many months? It is for 6 months. Is it right? We are preparing for 30th November. We have entered in on 2007. Fine. Now, is it right? Now, okay. Keep this one. Next one. How much we have taken the lease payments? Is it right? Lease payments is 350,000 for 4 years. Now we have to have a depreciation. Depreciation for how many months? 6 months only for the current year. Okay, 6 months only. How much is there? 350,000. Is it at 350,000? It divided by 4 by divided by times 1 by 4. Is it right? Into 6 by 12. How much you will get? Understand my point? See, is it lease payments is how much for 4 years? Is it right? Lease payments is how much for 4 years? 350,000. Lease is for 4 months. Now we want to know what is the carrying amount. Is it right? Carrying amount is how much? Carrying amount is how much? What is the lease payments? Present value of lease payments. Is it right? Present value of lease payments is how much? Present value of lease payments is 350,000. Okay, minus depreciation for 6 months current year. Is it depreciation for 6 months current year? Now the same thing applies. Is that how much you will get here? $350,000 into 1 by 4 into 6 by 12. How much? 43,750. Is it 43,750? Remove how much you will
Why
get?
you multiply 1 by 4?
4 years, na?
350. Yes, what about, I am asking about the one.
1 year.
Because it's 6 months.
No. How many total life is how much? 4 years.
Yes, 4 years.
4 years. Is it right? We have to take it for 1 year. Is it right? See the thing.
Okay.
350. Otherwise you do like this. 350 divided by 4 years. Okay? How much you will get?
Okay.
You will get how much? 87,500. 87,500 divided by 2, how much you will get? 43,750.
Okay.
You can do in either way, okay? This is the on left hand side what I have written is shortcut.
Okay.
How much you will get? How much you will get? Here 3, 250, 6, 0, 306, 250. What interest would be charged to Fino's statement of profit and loss account for the year ended 30th September in terms of plant lease? Keep it in mind, it is for how many? It is for how many? It is for 6 months only. Is it right? This is for 6 months only. Is it right? This is for 6. How much you have to charge? Is it right? How much you have to charge? Is that what is the present value of lease payments? What is the present value of lease payments? Present value of lease payments is 350,000. Fine. Interest we are talking about what? What is the amount of interest? Is it right? Means definitely we charge interest on what? Interest on the outstanding amount. Is that interest on the outstanding amount less initial we have paid? Is it right? We have paid advance. Is it right? How much we have paid advance? 100,000. Is it right? We have paid advance of how much? We have paid advance of how much? 100,000. Is it right? We paid advance of how much? Less advance. Is it right? How much you have paid advance? You have paid advance of 100,000. Is it right? How much you get? 250,000. Is it right? Is it 250,000? This is the outstanding. Okay, this is the outstanding outstanding payments. Is it interest at the rate of 10% for 6 months. 250 into 1 into 6 by 12. 25,000 into 6 by 12. It comes to 12,500. Are you clear about this? Next. Applying the principle of lease to capitalize the plant and recognize lease liability, what would have to impact upon the following ratios? They have mixed the ratio analysis here. Okay, they mixed the ratio analysis here. No problem. Return on capital employed. See what happens. Is it right? Whenever we take lease, is it right? Whenever we take lease, is it right? Your debt that is current that is current liability and non-current liability will increase. Is it right? They have increased current liability and non-current liability. Is it right? Now, what happens definitely is that it will be increased how much? The current liability and non-current. Apart from that, whenever you take lease, what will happen? When you take lease, the interest cost. Is it right? The interest cost, is it right? Interest cost will also increase because we calculate interest. Is it right? We calculate it. What is the return on capital employed formula? I'm writing in short. Okay, profit before interest and tax divided by capital employed. Is right? Profit before interest and tax. What is the gearing ratio? Gearing ratio is nothing but non-current liabilities divided by equity plus non-current liabilities. Very, very minor change will be there. Minor change. That is also, this formula will never change. Only the wordings will change. Okay, non-current liability, they will say long-term loans. That's all. Formula will never change as such. Okay, keep it in mind. We do anyway. The formula will remain same. Is it right? Interest coverage ratio. Is it right? 1 minute. I just reconfirm it. interest coverage ratio is nothing but, what happened? Where is, yeah. Profit before interest and taxes divided by interest expenses. Now, is it right? Now, what happens? See, interest cost will increase. Is that when interest cost will increase? Is that when interest cost will increase? This is the concept. Is it right? This is the when interest cost will increase. What will happen? Profits will decrease. Is that profits will decrease? Understand? When interest expenses increases, profits will decrease. When profits will decrease, return on capital employed will also decreases. Is that profits are decreasing? Definitely, returns on capital employed will also decreases. Is that very quickly? I will put it. Is that I will put very quickly. Is it right? I will. Is that what I will say? Option 1 is that when in increase, when it is decrease. Okay, I will put like this. Is it right? Assume interest is increasing. Is it right? Interest is increasing 2,000 divided by capital employed is how much? Capital employed is 50,000. How much you will get? 2,000 divided by 50,000. Is right? This is return on capital employed, profit before interest and tax divided by capital employed. If I don't put in numbers, you will not understand. Okay, 50,000. How much you will get? Here it is comes to how much? 4%. Interest is decreasing. Assume interest is how much? Interest is 1,600. Is it right? 1,600 divided by 50,000. How much will get? 1,600 divided by 50,000. It comes to how much? It comes to 0.032. 3.21. 3.2. Okay, now applying the principles of the capitalization plan, recognize that the lease liability, what would have impact on the following ratios. One minute. Applying the principles of IFRS 16, lease to capitalize the plant and machinery. Lease to capitalize plant and machinery. The lease liability would have what impact on the following ratios? What impact on the following ratios? Return on capital employed. Is it right? Return on capital employed is what's happening. It is increasing. Fine. Good. Return on capital employed is increasing. Gearing will, what will happen? Is it right? Gearing will, what will happen? Debt will increase. Is it right? Debt will increase. Is it right? 1 minute. Debt will increase. Is it? Debt will increase. 2000 is the debt. Is it right? 2000 is the debt. 2000 plus 4000. Assume 4000 is equity, 2000 is debt. It comes to how much? 2000 divided by 6000. It comes to 0.33. Okay. Now, if it is increased, is it right? If we 1 minute, if we are getting the result in the same way, then we can work it out. Is that if it is, assume that it is 1500 divided by 1500 divided by 1500 plus 1500 plus 4000. It comes to how much? 1500 divided by 5500. Is it right? 1500 divided by 5500. It comes to how much? 0.27. Good. That's fine. Okay. Interest coverage also I will do. See, unless until you don't write now, interest coverage. Is it right? What is the interest coverage ratio? This is high, this is low. Is it right? Interest coverage ratio is what will happen. What is the formula for interest coverage of profit before interest, taxes and interest expenses? Is it right? If profit before interest and taxes, okay, it is how much? I am taking only an example, okay, assumption. I'm thinking, I'm writing, okay, to explain you. 1500 divided by 150. Interest expenses are 150. It comes to how much? It comes to 10 times. Here how much? 1500 divided by 100. It comes to how much? 15 times. It comes to how much? 15 times. Now I understood. 4%, 3.2%. Okay. 0.33, 0.27. Okay. It is 10, it is 50. Fine. Now, what is the rule of IFRS 16 says? 1 minute. We will just go through that rule, okay? It will make things little bit easy for us. Is that it will be easy. Hope we have covered. 1 minute. We have covered right to use, lease payments. That's why theory is very important. Okay, theory is, it makes sense about how we are working it out. impact in the 15%. This is also example. No example. We have done this somewhere, is it? We have done this. This is a reciprocal lease. We have done somewhere. I remember we have. If the ownership lease over the other depreciation shorter period of time, define lease and payback. No. Carrying amount is there. Sale and lease back. No. No. What's happening here? I will explain you. Okay, I will explain what's happening here when we are talking about return on capital. First, understand this formula. Okay, profit before interest and tax divided by capital employed. Profit before what happening whenever we take the lease? Is it right? Whenever we take it on the lease, is it right? The interest cost will increase. Is it right? Interest cost will increase, and non-interest cost will increase, and non-current liabilities will also increases. Is it? We are showing it right hand side. We are showing it a right to asset. Asset will show on the asset side, and liability side we show it as a non-current liability and current liability. Fine, balancing the fact. Now, what happens when the interest cost increases? Is that profits will what will happen? Profits will decrease. Is that profits will decrease when what is there when profits are decreasing? Is it right? When the profits are decreasing, profits are decreasing. Is it right? Profits, when the profits are decreasing, see the things now. When profits will decrease, what happens to return on capital employed? Return on capital employed will also decreases. Is it right? When interest cost, this is where I can put it. Is that when interest cost is increasing, profits will decrease. Is it? When profits will decrease, is it? Profits are decreasing. What happens? The return on capital employed will also decreases. Is it? When interest expenses are not there, profits will be more. When interest expenses will be there, profits will be less. If profits will be there, automatically what will happen? The return on capital employed will decrease. I will put it as a note 1. Okay, I will put it as a note 1. Is it? That is the reason. Now, if you put the numbers, it will be very clear for us. Is it right? Now, is it? Now, gearing. What happens? Gearing. What is the formula for gearing? Gearing formula is this: non-current liabilities divided by equity and equity plus non-current liability. What happening when there is a lease? Your non-current liability will increase. Is it right? This is where we are talking in terms of increase, and this is where we are talking in terms of decrease. Fine, increase. When the non-current liability increases, is it right? When the non-current liabilities increases, what's happening to the leverage ratio? Is it what's happening to the leverage ratio? Leverage ratio will also increases. Is it right? Leverage ratio is also increasing. Is it? Means when we take the lease, is it right? When you take the lease, what happens? Definitely the component of non-current liability will increase. Is it right? When non-current liability increases, you put the numbers. Is it right? You put the numbers. This is with respect to what? This is with respect to note 2. Is it what happened? Gearing ratio will increase. Is it right? This is note 2. Interest coverage ratio. What's happening? Interest coverage ratio. When you are taking the lease, is it right? Is it right? When you are taking the lease, interest expenses will increase. Is it right? Interest expenses are increasing. When this is 150. Is it right? How much is the interest expenses here? 150. Here the interest expenses are increasing. Is it right? Here the interest expenses are increasing. When the interest expenses are increasing, what happens to interest coverage ratio? Interest coverage ratio will decrease. Is it right? Interest coverage ratio will decrease. Note 3. Little bit first time you are doing now, it's ratio analysis. Inshallah, I will again once we have done ratio analysis, again we will repeat it. Nothing is there. Okay, means the rule, the understanding says that, see, this is what the report of financial reporting. Whenever you are doing financial accounting now, you have to support with the numbers. How it's you have to assume it. Okay, just you assume it. One variable you keep it constant, another value you change, whichever is going to happen. Automatically what will happen? We will understand, yes, how it will be return on capital employed. When return on capital employed is when the return on capital, when the interest expenses are increasing, is it? When the interest cost will increase, profits will decrease. When profits are decreasing, the return on capital employed will also decreases. That is note 1. Leverage. When you take the lease, debt will increase. When the debt is increasing, what will happen? The leverage will also increases. You are taking more loan, is it right? Definitely your leverage will also increases. When you are taking more loan, your interest expenses will increase. Is that when you are taking more loan, your interest expenses will increase. When your interest expenses are increasing, definitely the coverage ratio will be less. Is it right? Is it clear? Little bit it is clear. I know complete. I'll say before you. Is it right? If it is little bit clear, fine. Okay. Next time, inshallah, we consolidate on that. Is it right? We consolidate a more practical one. That is why it makes little bit challenging. Should I repeat again? Fine. I can understand. Is that? I can understand. Okay means. Okay, fine. Okay, keep hold on it. Okay, don't worry. I'm here. I will explain you wherever it is going to be applicable. Fine. Wherever it is going to be applicable, I will do that. Don't worry about that. Okay. Next. It is also on the lease. Okay. It is also on the lease. On 1st January 2006, they have an agreement to lease machinery for how many years? 5 years. Is it right? With how much? 300,000. The asset has a useful life of how many years? 6 years. And the ownership to Lotso was at the end of the lease. The interest rate implicit at the lease is how much? 6%, and the present value is how much? 1.263. Fine. On January 1st, Loso sold its head office to finance company, but continued to use its sale and lease back. Is it right? Sale and lease back. Is it right? Sale and lease back. They have sold the office to the finance company, but they use head office for remainder 20-year estimated life. Is it right? The carrying amount the head office is how much? 10 million, and the fair value is how much? 111.5. Is it right? The 11.5. Okay. Now, what they are asking is, they are asking you the finance cost in respect of the machinery leased for December 2006 on the machinery. They are not asked, there are two things, is it right? One is they are talking in terms of machinery, and the second thing is they are talking in terms of what? In terms of head office. Fine. In terms of head office. Is it right? Machinery. How much is the machinery? The present value is how much? See, what is the finance cost? Is it right? Finance cost is nothing but present value of lease payments. Is it? Present value of lease payments times interest rate. Is right? Times interest rate. Present value of lease payment is how much? 1263 times 0.06. How much will get? How much you'll get? 7578. Fine. What is the current liability of near 1,000 recorded in the statement as on 31st during the machinery lease? Is it right? During the machinery lease 2006. Is it right? 31st 2006 machinery. That is the first one. Is it right? Machinery. When they have taken 2006. Is it right? 2006 they have taken. Is it right? Year, I will write slowly here. Year, is it right? Opening balance, is it right? Interest at the rate of 6%. Is it right? Interest at the rate of 6%. How much you have payment? Is it right? It is a closing balance. Is it right? It is a closing balance. Now, year is how much? 2006. Is it right? Year is 2000. Year ending. Okay. How much is the opening balance? Opening balance is 1263 in thousands. Okay. take it in thousands. Okay, take it in thousands. Okay, interest is how much? Just calculate 1263 into 0.06. Is it right? How much you will get? You will get, round it off. Okay, round it off. How much? 76. Is it right? 76. How much they are paying lease payments, or how much they are paying lease payments? They are paying lease payments of how much? Payable. How much? 300,000. Fine. How much they are paying lease payments? 300. Is it right? They are paying 300. What is the, what is it? This is 1, this is 2, this is 3, this is 4, 5 will be how much? 2 plus 3 minus 4. Okay, 2 plus 3 minus 4. 1263 plus 76 minus 300. It comes to how much? 1039. Okay, next 2007 1039, is it right? Times 0.06. How much is there? You put it at 62. Okay, you put it at 62. How much is the payment? 300. Okay, 1039 plus 62 minus 300. It comes to how much? 801. Is that how much? 801. Is it right? 801. Now, fine. 801. Okay. Now, how much is the total payment? Total payment will be how much? 1039. Okay, opening balance. Okay, opening balance minus closing balance is how much? Closing balance is nothing but non-current liability. How much is the closing balance? 801. Okay, 801. Difference is how much? Difference is 832. This is the current liability. This is the non-current liability. If you take in thousands, next. What is the carrying amount of the machinery, right to use? Okay, what is the right to use? How many years they have taken? What is the useful life? Useful life is 6 years. Is it right? Payments is how much? Payments is for present value of lease payments is how much? 1263. Is it right? What is the carrying amount? Carrying amount is nothing but, is it right? Carrying amount is nothing but present value of lease payments. Is it right? Present value of lease payments is how much? 1263. Okay, 1263 minus depreciation. Is it right? Minus depreciation. Depreciation for 1 year. Is it right? Depreciation 1 year. 1263 divided by how many life? What is the life? Life is 6 years. Is it right? It comes to how much? 1263 divided by 6. How much? 210,500. What is the difference you will get? 0052 0052
1052.5.
1010
52.5.
52.5. Fine. Next, what is the carrying amount of the head office? Is it right? What is the carrying? What is the present value of the head office? Present value of the head office is how much? 10 million. Is it right? Present value of head office is how much? 10 million. Is it right? Same rule. Nothing will change. Present value of, we don't have lease payments, is it? We have lease payments there. The carrying amount of the head office and the fair value of the assets is 11.5. On the we continue to head office. It is sale and lease back, is it right? 20-year estimated lease payment. The carrying amount of the head office is 10 million. Fair value and sale proceeds received is 11.5. Okay, 11.5. No problem. How much is the present value? Present value of what is the carrying amount of the head office? 1 minute. If carrying amount of the head office is there, is it? If carrying amount of head office is there, is it? What is the carrying amount? Okay, fine. Carrying amount as on 1/1/2006. How much is there? 10 million. Less depreciation. Is it right? 10 million divided by how many years? 10 million divided by 20 years. How much will get? 0.5 million. 9.5. This is as on 31st December 2006. How much is it? Fine. Identify if the statements below are true or false. Again, this we have. If the sale and lease back in a sale and lease back transaction, no profit will be recognized by the lessee. No, in sale, see, when we are talking in the sale, is it right? Sale and lease back, definitely what will happen? Profit will exist. Is it right? Profit will exist. It's not like that we don't have the, will not have the profit. Is it right? Profit will be there. This statement is false. Is that in a sales, no profit. There is not. Profit will be there. Is it right? In a sale and lease back, the sale process will usually be treated as a loan to lessee. No, there is nothing a loan. Is it right? It's not. It's a straightforward transaction. Is it right? It is a straightforward transaction. Is it right? This is not a loan as such. This is also false. Is it right? If they are using it for a remaining life, see, I will write the reason also. Is it right? Is it right? I will write in sale and lease back. In sale and I'm writing the explanation. Okay, why it is false. Is it right? That does not retain the asset. Okay. The in the sale back, seller and the lessee seller does not retain the asset. Is it? 1 minute. Is seller, you put it very clear. The seller does not retain the asset. Is it right? Does not retain the asset. It is deemed to be a sale. It is deemed to be sale. Deemed to be sale. Fine. Is it? Deemed to be sale. Means when you are selling the asset, it is sale. That's all. We are not going to take it as, we are not taking it again, you are not going to purchase it. We are taking it on a lease. Is it right? In this case, in this situation, the profit will exist for the seller. Fine, for the seller. Okay. Whereas in a sale and lease back transaction, then the sale price will usually be treated as a loan. No. Is it right? Is it? It is treated as a loan only when, is it right? Only when the seller retains use of asset after lease. Okay, after lease for remaining life. Is it right? That is the explanation. When we say it is true, when it is say it is false, we have to understand with reason. The first one is, in a sale and lease back, seller doesn't retain the asset. As simple as that. Is it right? Then definitely there will be a profit, there will be a loss. In the second case, it is not a loan. Is it right? When it is loan, fine. You are having 6 years. You are going to say that after 5 years I will take back my asset. Is it right? I will buy my asset. You have to return my asset. As simple as that. If you have return, means it is a reflection of a loan. Okay. Return means it is a reflection of the loan. But when you are selling it back, there's nothing like we don't retain the use of the asset. Is it right? Means we are breaking the transaction one side, and we are the title, ownership title will change. If ownership title will change, the concept of loan will never exist. Okay? We will do this, is it right? We will do this. This is where can we do this? We'll do this. Alhamdulillah, previously we used to do only 15 questions. Now, little bit improvement is there, is it right? This is what financial assets and financial lecture 9, okay? This is chapter 9, is it right? Chapter 9, it is financial assets and liabilities. If time is there, we will do one other question, no problem, okay, inshallah. If you are exhausted, tell me. Fine, is right? On first, on 1st of September 2003, Laidlaw factored 2 million of receivables to Finis. Means sold. Factored means what is that? You are selling the receivables. Is it right? Receivables and converting the receivables into cash. Laidlaw received an immediate how much? You have sold it 2.2 million, but how much you got it? You got it 1.8 million. Under the factored agreement, any receivables not collected after 4 months will sold back to Laidlaw. Means the amount has to be collected within 4 months. Is it right? If it is not receiving, then you have to return back to the person. On first, this is on 1st of September. On 1st October, almost 10 months back. Is it right? 10 months back. Laidlaw sold some maturing inventory which cost 4.5 million to the bank for its fair value of how much? 5 million. Fine. Under the terms of the sale agreement, Laidlaw has the option to repurchase the inventory after a period of 10 years at how much? 7.4. At this date, the fair value of inventory is and the repurchase reflects the equivalent annual dividend of how much? 4%. Okay. So many things. Fine. Laidlaw issued 10 million convertible loans on 1st October, carrying a coupon is how much? Coupon is 5% and redeemable on 2005. A similar loan without conversion is how much? 8%. We will go from question to question independently. Okay? Question to question independently. Which one of the following is correct regarding Laidlaw factoring of trade? See, what is factoring? First you understand this. Is it right? I have explained you this. Factoring is nothing but, is it right? Factoring is nothing but we will have receivables. Is it right? We have receivables. Receivables, we assume that receivables is going to be 200 million. Okay? 200 million. 2 million. Is that? We'll take 2 million only. Okay? Receivables are how much? 2 million. Now what we'll do, we'll go to the bank and say that I want to convert this 2 million. I'm having a post post dated checks. Is it right? I am having the post dated checks. You take these post dated checks and give me the cash. Okay, but what the bank will do? Bank will give cash. How much? Bank will give cash of 1.8 million. Okay, 1 point. Is it? And in future, bank will collect the amount on behalf of the client. Okay. Now, what it says, which of the following is correct regarding, let's say, factoring of trade receivables? Is it right? 200,000. Is it right? 2 should be recorded as administration expenses. It is not administration expenses. If you ask me, it is the commission fee. Is that the difference of how much? The difference of 200,000 is what? Is the commission. Is it? This is not the right answer. The receivables should be removed from the statement of finance. Receivables will not be removed. Receivables will be there. Is it right? Receivables will be there. Is it right? Till you are getting. See what happens. We see. Otherwise, what after 4 months? Is it right? After 4 months. If no recovery. Is it right? No recovery. Is it right? It will be what? It will be back on balance sheet. Is it right? So receivables will be there. You cannot say that I will remove receivables from my balance sheet. No. This represents a without recourse factoring agreement. See, recourse and without recourse is nothing. But recourse means you will take it back. Without recourse means you will not take it back. It is not the condition. What it says, the condition has been very clearly defined. Is it right? The conditions has been very clearly defined that any receivables not received, not collected after 4 months will sold back to whom? Will sold back to Laidlaw. It means it is with recourse. Is it right? It is with recourse. Is it right? That is, this is the with, because it is sold back to Laidlaw. It means it is with recourse. This is also not. The receipt of 1.8 should be, it's as simple as that. Is it right? You are receiving how much? You are receiving cash of how much? 1.8. This 1.8 will be treated as loan. Is that will be treated as loan as such. What amount is it that should be recorded? Are you clear about this?
Can you repeat it again?
See, yes. See, you have what we have done. See, keep it in mind. Is it what we have done? Factoring. Is it receivables? How much is the receivables? 2 million. Okay. Post dated checks. Assume you have gone to the bank and how much you have taken? They will not give full amount. They will take 1.5 and the balance 200. They will treat it as a commission or fees. Okay. Commission or fees means how much you have taken. You have got 1.8. Okay. Now, what is the correct statement they are asking? Is that what is the correct statement they are asking? What is the correct statement? They say that 200,000 should be recorded as, this is not administrative expenses. What is the administrative expenses? Rent, salaries, all those things. This is the commission we are giving. Is it right? This is the commission we are giving. That is the reason this is wrong. The receivables should be removed from the statement. No, we will be there. What maybe happen after 4 months? You are not, bank is not recovering the amount. Is it right? Bank is not recovering the amount. If they don't recover the amount, definitely it will be back on what? It will be back on the balance sheet as such. Is it right? So we should not remove until it is collected. It should not be removed. Is it right? The liability is still there with the client. The liability is not there with the see, that is what it says. The liability, the rule is the liability will be on the client only. The liability will not. This is one of the conditions with respect to the factoring. Is it right? Next. Means the liability will, if the till the liability is there, it has to be shown in the balance sheet. Now, what is the recourse and what is the not without recourse means once sold. The rate of interest will be high without recourse, because without recourse the bank is taking high risk. With recourse, the bank will take the less risk. Here what happening, there is a clause is attached to that. There is a condition that has been attached. What is the condition they have attached? They said if any receivables not collected after 4 months will be sold back. If this is the case, this is called as without. This is called as 1 minute. This is called as with recourse. This is called means there is a condition, there is a clause in there. If it is, I'm not receiving the money after till 4 months from the third party, whoever checks have been taken. Definitely, if I will not hold it, is it right? I will get back to the things and I will pay you back. Okay. That is what the with recourse and without recourse. Fine. What happens that this is not a without recourse. This is the condition with recourse. And definitely what's happening? You are taking how much they are giving you. If assume, getting a point. If assume, make it very clear. After 4 months, is it no collection? No collection. What will do? Bank will return the receivables. Is it? Return the receivables and treat this amount as loan. Is it right? Treat this amount as a loan. Fine. This is the amount which has been, this has been amount that has been reflected here. Is it clear about this?
Yes, it's clear.
Next. What amount should be recorded in equity to the nearest thousand in respect of convertible loan notes? Is it in convertible loan notes? How much they have given the loan notes? Loan notes are how much? Issued 10 million convertible loan notes or 5%. Is it right? They have issued how much? 10 million convertible loan notes. Redeemable on 1st October. It's 2002, 2003, 2004, 2003, 3 years. Is that 3 years? How many years are there? From 2003 to 2005, it is how many years? 3 years. Is it right? It is how many years? 3 years. Now, every year they will give you 5% interest. Is it right? It will be discounted at 8%. Okay? It is discounted at 8%. Fine. And what we have to do, we have to take the cash flow 5%, discount it by 8%. How much amount we'll get for 3 years? Is it right? And after 3 years, whatever the liability minus total amount is nothing but the equity. Is it? Liability convertible loans minus the total amount, it will be how much? It will be the equity. Fine. We have to, they give you the percentages for 5 and 8 also. Is it right? is it? Now, year ended, is it right? Year ended, cash flow, is it? Discount rate, is it? Discount rate at 8%, cash flow at 5%, that is the interest, okay? That is the coupon. I can put like this, is it right? It is not interest also, it is a coupon, okay? It is a coupon. Is it right? Now, the last one is discounted cash flow. Is it right? Now, this is not that much required, okay? Fine. Year is how much? 2003, okay? 2000, year ended 2003. How much is there? How much is there? 10 million into 0.05. Is it right? 10 million into 0.05. It comes to how much? It comes to 0.5 million. Check again. 10 into 0.05. Is it at 0.5 million? Okay. 0.5, is it at 0.5 times, what is the 8%? They have given to us 8%. Is it right? How much is the 8% discounted? 1 minute, we'll do like this. Is it right? We do like this. Discount rate at 8%. How much is the discount rate of 8% is how much? It is 0.93. Okay. This is column 1. This is column 2. This is column 3. Column 4 is nothing but 2 times 3. Zero 0.5 into 93, how much? 0.5 into 0.93, it comes to 0.465. 2004, is it right? 0.5, is it right? How much is that discounted? 0.86, is it right? 0.5 into 0.86, it comes to how much? 0.43. Okay. Next, 2005, 0.5 into 0.79. Is that 0.5 into 0.5 into 0.79? It comes to how much? 0.395. 1 minute. 1 minute. Sabar. Third year, is it right? Third year, what happens? Third year, we are making investment for 3 years, is it right? Redeemable on 1st of October. As a semi-loan will be conversion, will be done. Means what happens? How much you will get on 1st October year ending? On 1st year ending, how much we'll get? We'll get 10 million plus 0.5, is it right? 10.5 million. Is that how much you'll get? 10.5. Is that we'll get principal plus interest. Okay, we get the principal plus interest. How much? 7.76. Is it right? 10.5 into 0.76. 10.5 into 0.76. 7. Allah Karim. 1 minute. Is it right? How much is it? 0.79. Sorry, I've written 76. Okay, 10.5 into 0.79. It comes to how much? 8.295. Fine. Now, this much they will get. Is it right? How much, if you make a total, how much is there? Make a total 0.465 plus 0.43 plus 8.295. It comes to how much? 9.19. Understanding what's happening? You have conversion bonds. Is it right? Conversion bond. They have issued on 1/1/2002. It will be redeemed on 31st. It will be redeemed on end of 2005. Is it right? Every month, every year you will get you will get how much interest? You will get a interest of how much? At the rate of 5%. Is it right? And this amount has to be converted with discount factor of 8%. Fine. Now we will get the discounted cash flow. Is it right? By the year 3, is it right? By the end of the year 3, how much is the value of present value, discount present value we'll put like this, okay? Discounted value of bond. Is it right? Discounted value of bond is how much? This much. Minus, is it right? Minus issue value of bond. Is it right? Issue value of bond. How much? Value of bond is how much? 10. Is it? Difference. Is it? Difference is how much? Difference is how much? 10 minus 9.19. Is it? Difference is how much? 0.810. Is it? 0. This is called as equity. Fine. Good. Just three small questions. Theory questions are there. Theory questions, it can be done very quickly. Is right? Nothing is there. Okay. Theory questions is very simple. Which two of the following? Alhamdulillah, we did 20 questions. It's a good improvement. Otherwise, for every time we used to do only 15. Which two of the following items should be recorded later financial statements for the year ended in respect of maturing inventory sale? Is it right? Maturing inventory sale. What is the source of maturing inventory? It has 4.5 to 5. Okay. 5. Under the terms of sale agreement, the option to repurchase inventory after 10 years is 7.4. The date value is how much? 11. See the things. Okay. I will here. Fine. Is it right? Is it right? Now, what happens? See the things. Is it right? What happens? That's it. 1/1/2002. Is it right? 1/1/2002. 1/1/2002. 1/1/2002. What is the sale value? Sale value is how much? Fair value. Fair value is 5 and carrying amount is how much? 4.5. Is it right? Is it? Fair value is how much? Fair value is 5. Is it right? Fair value is 5 million. Is it right? And the cost is how much? Cost is 4.5. Is it right? 0.5. 0.5. Fine. Next, what happens again after 10 years? 10 years, fair value is how much? Fair value is, after 10 years, fair value is how much? After 10 years. Repurchase the inventory period of 10 years at a price of, at that date, fair value is how much? Fair value is 11 and the repurchase price is 7.4. Fair value is 11. Is it right? Repurchase price is how much? Repurchase price is 7.4. Is it right? How much you will get? How much you will get? 3.6. Okay, 3.6. They have taken what? See that is. They have see what they have said. They have taken loan. Is it right? Fine. This is one aspect. Okay. This is one aspect. Now they have taken a loan. Is it right? They have taken a loan of how much? 5 million. Is it? They have taken a loan of how much? 5 million. Fine. Fair. See. Which cost 4.5 million to a bank. Is it right? For a fair value of how much? 5 million. Is it right? To a fair value of 5 million. Is that so? Yes. Is it? This is what? This is the bank. Is it right? They have taken the bank. What is the fair value? Fair value is this one. Now the fair value minus, it is nothing but it is which was to recorded less financial for the year ended in respect of maturing inventory sale. Is it right? Maturing inventory sale means 30th December 2003. Okay, 1 minute. Next, 1 minute. We are. Is it right? 1 minute. And on 5 million at the rate of 4%, how much we will get? 5 million at the rate of 4%. How much we will get? We'll get 0.2 million. This is the interest. Is it that? This is the interest. Means total. See what happened. They say that 2,000 is the finance cost. Is it right? 200,000 in the finance cost. We are asking what? We are asking the maturity inventory sale. Is it right? We are talking in terms of financial statements. Is it right? Recorded in the financial statements means both in terms of the profit and loss account as well as of balance sheet. Okay, balance sheet. Now when we are talking in terms of both, in terms we are here, what's happening here, we are only talking in terms of, we are taking in terms of profit and loss account. Is that we are not, we have to take into consideration profit and loss account and balance sheet. Now 2,000 finance cost, fine. 50,000 release of deferred income. Is it right? 50,000 release of deferred income. See what happens. This is where it says. Is it right? This is what it says. If you take into consideration, if we understand like this, Is it right? If you understand like this, how much is there? How much is there? You have 5 million loan, 4.5 is the cost, and deferred income will be the balance of 500. Is that zero point 0.5? Is that the balance of 0.5 is going to be treated as what? It's going to be treated as a deferred income. Is that it is as a deferred. Now, how much is the finance cost we are having? We are having a finance cost how much? 4%. Is it right? We are having a finance cost of 4%. Means how much the interest finance cost is how much? 4%. Is it right? The finance cost is 4%. The loan amount is how much? 5 million. Is it right? The loan amount is how much? The loan amount is 5 million. Means what happens? The total amount including interest is how much? Total amount including interest is 5.2 million. Now you see the thing. One side we have to in the profit and loss account will show only the interest expenses. In the balance sheet we will show the amount to be repayable. Is it right? Amount to be repayable. Amount to be repayable including interest. Okay? Amount to be repayable including. Now, if you say the thing, this is the amount we are paying in the profit and loss account. Is it right? How much is that? This is 5 million into 0.04. Is it right? 0.1. Deferred income, that is means what we are going to receive in future. That is not going to be considered. Is it right? 5 million revenue, it is not revenue. Is it right? We are taking the loan. Is it right? It is not revenue. Total, how much we are going to show in the balance sheet? 5.2 million. Is it right? 5.2 million. Deferred is not a liability. Is it right? It is not a liability we are talking about. There is no liability as such. It is a loan. Is it right? Deferred income. Right now they are paying us. They are not paying us in future also. Is it right? Means that is also not workable. There is no gross profit as such. Is it right? It is not a transaction we are doing. Means answer is what? Answer is A. Answer is A and D. Simple. 2000 is the finance cost at the rate of 4%. Total liability is 5 million plus 200,000, 5.2 million. Is it right? Answer is what? Answer is this one as well as this. This is we are showing in the balance sheet. This is we are showing in the financials. Is it clear?
Yes.
Is it? Fine. Which of the following statement regarding the convertible loans is not true? Is it right? Which of the following statement? Is it right? The convertible loans, is it right? Notes will affect gearing due to liability component being different to the equity component. The equity amount will remain fixed until the date of conversion. This is true. Is it right? This is true. The equity amount will remain fixed till the date of conversion. The liability at 2000 will be the liability at 2000. No, what is it right? The liability as 2005 will be, yes, till it is not conversion, the liability will be liability. Is it right? Till it is not conversion, it will be a convertible bond only. 5% interest will be charged to the statement of profit as loss account as a finance cost. It is true. The convertible bonds will affect the gearing. It will not due to liability component being different to the equity. Means what happens? See, first have a clarity on gearing. Gearing ratio is nothing but non-current liability plus non-current liability plus equity. Is it? see, the till the conversion date, is it that the till the conversion date, the calculations will never change, is it right? You cannot change the gearing ratio till the conversion date. After the conversion date only we can change we can convert the bonds into loans, into equity. Is it what they are saying in the first point? They are saying in the first point that the convertible loans will affect gearing to the liability component. One minute. Just keep, okay? Just keep. Okay, I will explain, okay? I will explain. Now, if I explain in a rush now, I cannot do that, okay? I will explain. Just put it, I will explain you, okay? This I will explain next time. I have, this is the second question which I have kept it pending, okay? In this section, okay? We will do. Applying the principle of split accounting to convertible loans is important to satisfy which of the qualitative characteristics. Is it right? Which applying the principle of split accounting to convertible loans. Is it right? Split characterable of convertible loans. Is that? It's not. It's when we are saying split it about qualitative. Is it right? Qualitative characteristics. Relevance, verifiability, timeliness, faithful representation. Timeliness with respect to time, verifiability with respect to the evidence, relevance with respect to the one. Is it right? See, if we follow the faithful representation, if we follow the faithful, time is also going, that is the reason. If you follow the faithful representation, it means we are satisfying the true characteristics of convertible bonds. Is it? Of convertible bond. Is it? Relevance is nothing but disclosure. Is it right? Relevance is nothing but disclosure. Fine. And is it right? Relevance is with respect to disclosure as such. Is it? Verifiability with respect to the amount. Is it right? Verifiability with respect to the amount. Timeliness in terms of duration. Okay? Fine? Stop here. We will stop here, inshallah. Is it right? We'll stop here. 2 questions are pending. Okay? Inshallah, I will tell you. It will take time. That is the reason I have holded it. Okay? Is that? The question number 3044 will take time. I will explain you. And again, 304, I kept it pending. Another one which I have kept it pending is which one? This one, 289. Okay, 289 and 304. I will, inshallah, I will